you know. And as you said, if you went back to the 50s, maybe I don't have that chart in front of me, but I'm sure we'd see the same kind of roller coaster up and down, you know. And if you look at this chart now, it looks very dramatic, but in 10, 15 years from now, when you zoom out, like it'll probably be similar. Like there's probably going to be something else where, you know, rates come down, they stay stagnant for a while, something happens that triggers them up or down and so on and so forth. So I think we've just been fortunate that we haven't seen these fluctuations in our home ownership cycle, you know, unless you bought before 2006.
You're listening to the Ottawa Real Estate Podcast with your hosts, Paul Stevenson, David Warren, and Greg Campbell. Let's see what's going on in the world of real estate today.
Recording in progress.
Yes. Hello, everybody. We are back. We're back. It's August.
Has been August.
It's I guess it was August last week too. When August for me. New episode in August for me. Okay, I'm back. I'm feeling good. I came off a vacation the week prior, which had been planned for a few years. Went out west with the kids and Sandra to Banff, which was amazing, and came back and then got the post-vacation 1-day flu. You know, you come home, you're all jacked up, and then your body crashes, and you're like, okay, back to reality. You know,
post-vacay vid.
That's what they call it. Oh, geez, right in the deep end. Don't know about that, but we'll see.
The V squared, the vacay vid.
Yeah. Welcome to the Ottawa Real Estate Podcast. My name is Paul Stevenson. I am one of your hosts, and I'm here today with David Warren. Greg, unfortunately, is not with us. We'll get the trifecta back at some point, actually. We actually, next week, I might as well mention it now, we're going to be live on Tuesday night, and we're going to have a special guest. One of our lenders, Darren Campbell, is going to be joining us from Westboro. And he's going to talk about all the great things they're doing over there. And figured a live show would be a different vibe for a guest. You know, they can actually chime in and people can ask questions. And I think it'll be a pretty good dynamic.
We also have done them before plenty of times. We just forget to actually mention it on air the week prior. So
then people are messaging us Tuesday, like, where's the show this week? And oh yeah, we're doing it tonight. Forgot to mention that. So Tuesday night next week, which will be, I think, the 16th, 15th, we'll be live. So make sure to tune in for that. If you haven't already, before we get into it, obviously make sure to subscribe, like, and share the channel. And we're here. We're back. It feels good. We took a long break, or maybe too long a break. I think we all kind of got out of the saddle there for a month and kind of did our summer things. It seems to be what's happening in the market as well, David. People are taking vacations and doing their summer things, you know.
Great segue.
Thank you. Yeah. we saw the numbers came out last week for Ottawa for the data for July. Number of sales were down. We can get a bit deeper into the stats, but average sale price was up and months of inventory was up. So, you know, we saw a number of sales. We saw 979. This is, I think, freehold, because I think there was actually a few more. I think it's about 1,200 if you include condos. So just under 1,000 freehold. Average sale price was 754,000. So up about 8,000 from June. And then months of inventory now is sitting at 2.7 months. So it seems like, don't quote me, but it seems like things are balancing out.
Mm-hmm.
Would you say?
Yeah. I mean, from May, we are down as low as 1.5 months of inventory at 745 average home price. And it's kind of ticked up and almost doubled in inventory on the market, but that sale price has increased. I think one of the interesting points of that freehold average sale price is that it's actually up 5% from 2022. Mm-hmm. So from June, from July 2022, we're actually up 5%, which is, I think, for a lot of people would be surprising to hear. And then the same, you know, as you mentioned with the condo month over month, there was 284 sales average sale price of 435,000. The months on inventory ticked up pretty dramatically, 2.3 months. In June, it was only 1.4. But again, the average sell price the average sell price was still up 2% from a year ago, which I thought again is pretty interesting. I mean, certainly we see it, and Greg and I were talking about it last week as well, that people go on vacation July and August, kids are out of school, people kind of stop looking at homes or purchasing. They don't want to move or they're tied up with kids being back at home, maybe not in camps yet or anything like that, but everyone kind of away taking vacation. And we certainly see that over July and August. But I thought what was really interesting all of that data is just that the average price points being up from last year.
Yeah, I've seen at least, and I know I use my street as kind of a microcosm of the world, but I've seen multiple listings come up on the street recently, and we were saying that last time there was rate hikes that we would probably see an abundance of listings coming out. I know this only shows sales, but I would love to see. Well, I guess the inventory there it is. Yeah, never mind. I was gonna say I'd love to see how many more like new listings came out. There's no actual like number, but an extra 6 months of inventory means obviously there was an increase in listings, and you can actually see the last major rate hike, which was I guess May, April. The inventory at least slightly crept up, and then obviously plummeted once everyone started buying homes. But rates has been interesting the last couple of weeks too, Dave, because we've seen now speculation that with some of the inflation and unemployment numbers coming out, that there probably won't be a rate hike in September. Very likely. Who knows?
It's a yo-yo. It's a yo-yo. Day by
tomorrow
day.
It'll be guaranteed. But also the fixed rates. We were mentioning before we came on the air here that we've been seeing the bond rates come down as well over the last week since that announcement of the unemployment. So, where, in your opinion, where do you think rates are going in the next 3 months, let's say? Because that's our business is we always work on kind of a 120-day cycle, right? We're always locking people in for 3-4 months ahead. So what kind of conversations are you having, and where do you see those rates going?
So last week's conversations were interesting because the by and large most all banks increased their fixed rates pretty dramatically. They jumped up 10, 15, even 20 basis points for a lot of the major banks, for a lot of the monoline lenders as well, on conventional and insured rates. And that was because the bonds had been trading up over 4% and are hovering around 4% for a little while. And so, and I know we talk about the bonds. We've been talking about it kind of more recently or over the last little while. There's a misconception that what the Bank of Canada does with the overnight lending rate affects fixed rates, which is not the case. There is a little bit of a correlation, but fixed rate mortgages are tied to the corresponding government bond. So a 5-year fixed is tied to the 5-year government bond, 4-year government bond, et cetera. All the rates increased end of last week, kind of in that Wednesday to Friday mark. But on Friday, the 4th, we had the Canadian unemployment numbers come out, and it crept up. So the unemployment rates went to 5.5%, which we then immediately saw a drop in the bonds. They look for in the market for, positive numbers, if you will, for inflation to slow down, for what's going on with the figures. So higher unemployment is actually a good thing for the bond market and for the Bank of Canada, but they want a higher unemployment rate. They want inflation to slow down. And so you can actually see on this graph that, Stephen, if you can bring it up there, if you don't already have it up, that you can see on Friday, the 4th, it dropped pretty drastically. We kind of saw it fall off, and we've seen it, kind of this morning it opened up already. It's down 8 basis points today, with the market being closed yesterday. I think what happens is if this sustains, so we were on Thursday, opening of the market Friday, we were over 4% for the bonds. So bonds were at 4.06%.
They weren't looking good either. It had been a pretty steady trajectory upwards.
Yeah, and then and really, when that happens, the banks borrow off the bonds, and they have a spread for where they price their fixed rate mortgages. So they're borrowing against that bond. As we see it come down for a steady period of time or elevate for a period of time, that's when they adjust that spread and where they see your rates. So they're up right now. There is quite a bit of spread between them. I think if it maintains kind of consistently going lower and positive information coming out of the market, meaning inflation coming down, higher unemployment, pain in the market, if you will, is kind of a good thing. But then we'll see those rates tick down. And when it's consistent for a period of time of staying low, that's when you'll see the banks start dropping the rates. So really over the next, really month leading into September's announcement by the Bank of Canada, I think it'll be interesting to see how these numbers sustain, if there still is increasing positive data coming out of the from Stats Canada, from where things are at, leading into where inflation's at prior to that announcement. I think that's really going to dictate. It's hard to say because early last week we would have said that rates are going to continue to elevate and stay elevated, but then we have some good data coming out that surprised the market actually. So it's so difficult to predict right now. Again, I think kind of looking at those shorter term rates even though they are in the mid, low and mid sixes now for the 3-year and 2-year and things like that. But I think those are the conversations that need to be had, and people need to think about of kind of that hedge, if you will.
Mm-hmm. Are you still I'm still having a lot of people, and again, there's always a lag. Like it seems whenever, the reason I'm saying this, sorry, I still have people asking about 3-year fixed, like 2 and 3-year fixed, with the anticipation that rates are going to be down. We talked about this 6 to 12 months ago, maybe, which I think was probably when the 5-year rates first started to spike up. I think that was probably your best bet to get into the 2 and 3 years. The 2 and 3 years obviously have now caught up where they're high 5s, low 6s, and doesn't seem to make sense for many people. There's a couple lenders I've seen that are in kind of the high 5s that some people are still interested in. But I think, as you said, if we can see these bond rates hold for another 2 or 3 weeks, I think lenders will probably respond sooner than that. But I think lenders are very reluctant to drop rates. Not that they're necessarily greedy in the sense that they want to keep the rates high, but I think when they start dropping rates, it does create a ripple in the market of, I don't want to say excitement, but activity maybe. People are, rates are declining now, So as soon as that rate ticks down and people are like, oh, the rates have actually dropped this week, then it seems to stimulate the market. So I think there might be a bit of a lag there where they're kind of waiting, as you said, to see how long are these rates, how long are the bond rates actually going to stay low before they float down. Whereas if the bond rates go up maybe for a couple of days, okay, well, let's get that spread back, let's increase the rates. So I would say we'll probably be at least a week or two before we see rates start to decrease, which, as you said, kind of lines up very nicely with the Bank of Canada announcement. Obviously different metrics, but I think, they seem to at least be moving around the same time over the last year and a half or so. There's a graph that I sent Stephen, which was kind of the historical mortgage rate since 2006, which I thought was a very interesting visual because, people, as we said, everything is cyclical, but you can see, if Stephen has a graph up there, I'm not sure if he does, but it shows basically a graph shows 5-year fixed rate mortgages, 5-year variable rate mortgages, and then 3-year fixed rate mortgages. And it shows the best Canada mortgage rate comparison. So kind of just a nice, for anyone listening, it's just kind of a nice graph right across the board. And you can see the massive spike, obviously, 2022, especially in the variable rates, pretty much just the wrong type of hockey stick curve that you don't want to see when you're a homeowner. But they are kind of hitting that orange line, I think, is as of today. And, whatever goes up has to come down. So I think, there's only so much further that we can see rates go up. Obviously, I'm not an economist, but just from what we've seen and looking at these graphs, I mean, there's, we're a lot of people are very tight. As you said, the unemployment rates now have shifted. I think that the inflation numbers, which I don't know exactly when the next announcement for that is as far as CPI, but probably in the next few weeks. that'll be very telling. And obviously, as we all know, that we're coming into potentially an election year as well. So, there's a lot of, I think, movement and a lot of, backdoor conversations that are happening regarding all of these different statistics and how they impact things and, what sort of shifts they want to make and so on. So, yeah, I think, I heard another one of our agents, not our agents, but another agent kind of in the mortgage broker community stating that, time to buckle up because the next, 6 to 12 months is going to be interesting. It'll be interesting to see where everything lands.
Yeah, I completely agree. It's I'm sorry, I'm kind of looking to see when the announcement for the next inflation report.
Yeah, I feel like it's not as widely announced. They just kind of like, hey, by the way, the numbers are out. It's like, what? Nobody knows. Nobody expects it.
Yeah. But yeah, I think it is, to your point, where we're at, and I know we've said it before from a rate perspective, but looking at that shorter term, when you look at that graph, I think that's great. You kind of see that spike in 2009, I think it was showing. Obviously not a great year of 08 and 09 in the US market, but it does show you what kind of happened with our rates as well and where they were and how they were still impacted with what was going on in the States when we weren't as affected. But everything is like cyclical. When you look at the historical rates dating back to 54, you can find those graphs of kind of where prices have been within Ottawa, where rates have been, and there are years in which there's double-digit growth, and from a drop in value, it's typically never been, or I shouldn't say never. I believe the stat actually since 54 in Ottawa at least hasn't been a double-digit decrease year over year figure. So I'm curious to see. Right now we're 9% off last year's high. So I'm interested to see where we end up by the end of the year in that regard, to see if we break that double-digit drop. I think if we hold steady with, kind of, again, I put in air quotes, but positive data coming out from Stats Can of unemployment, inflation, and core inflation, and all of that we'll hopefully see rates start ticking down. Which, coming out of the Labor Day weekend and kids back in school is typically when the market picks up normally anyway. So this high inventory of 2.7, I think it likely will tick up through August as well. Yeah. And I'll be interested to see what that looks like come September and October. Of where, those will be I think those 2 months will be, really just September's almost alone will be kind of indicative of where we're going to end up on the end of the year. I feel from a pricing point, year over year, inventory, all that, of where our trends are heading, because you're kind of two things that are coming into play and coinciding is Bank of Canada rate announcement beginning of September. You've got the US inflation numbers coming out beginning of September as well as Canada. And that's typically when the market picks back up anyways, because kids are back in school. So you have, if we stay even from the Bank of Canada, and it's strong numbers of inflation coming down and unemployment going up and things like that, and inflation from the US coming down, then I think we will see a strong September. But it'll be really interesting to see how those kind of line up.
Yeah, and a strong September too would mean, if people are buying in September, they're probably not closing till, October or November. So when we're looking at these the sales numbers and so on, that's when the actual transaction happens, right? So anyone buying in September, we probably won't actually see that till October, November, December as far as sales. But I agree. I think August, we're going to see a lot more listings. I think there's probably going to be almost like an oversupply for a couple weeks. And then I think September is going to be kind of gangbusters. Like everyone that's kind of been waiting will be like, all right, let's pull the trigger, let's get it over with. And especially if we see, as you said, positive news in the sense of rates potentially declining and so on, like we could see a really huge ramp up at the end of this year. I wanted to go back to that chart quickly about the mortgage rates. I think we're also, anyone who's bought a home in the last, say, 15 years is probably in this weird kind of delusion of rates, like their expectation of rates, because if you look at that graph from basically like 2010 to 2020, there's really no movement. Like it ranges from maybe 3.5%, maybe high, like or high threes, sorry, low fours, but never goes crazy high or low, right? And then when COVID hit, we saw rates plummet, which was obviously unprecedented, and now they've completely spiked up, which was also, at least over the last 10, 15 years, was unprecedented. So people had never been through that sort of fluctuation, and as you said, if you went back to the 50s, maybe I don't have that chart in front of me, but I'm sure we'd see the same kind of roller coaster up and down, and if you look at this chart now, it looks very dramatic, but in 10, 15 years from now, when you zoom out, like it'll probably be similar. Like there's probably going to be something else where, rates come down, they stay stagnant for a while, something happens that triggers them up or down, and so on and so forth. So I think we've just been fortunate that we haven't seen these fluctuations in our home ownership cycle, unless you bought before 2006. But as you said, like everything's kind of cyclical. And that's why I think like we see the numbers down in July as far as transactions. That to me just makes me think like August will probably be similar. And then like we saw January, February, March, we saw a slight increase. April was higher. May was kind of the pinnacle. And then it started to come down again. I think August will balance out. And I think, as you said, September, October, November, we'll see the numbers come up again. And then, December, January probably stagnate a bit. But who knows? What do we know, David? We're just here for the coffee,
Yeah. I think one thing that to your point of us being lucky within Canada the last 15 years, and even like you said, looking at that chart, averaging between 2 and 4% for fixed and variable through that whole period. I believe they say that around the 4 to 4.5% mark is where mortgage rates should be for fixed, to create more of a balanced market. We've seen such a run up of prices within Canada from, for various reasons. Low interest rate environment creates demand, but also obviously, crazy, high in immigration, which we've been seeing more recently as well, and supply not keeping up. So I'm curious to also see over the next period of time how that rates kind of, whether they do come back to that in the threes or whether they stay more in that 4 range. I mean, in Canada, we have been on the very much the lower end of rates when you look across the world. Even the US, like the typical rates, like a good rate is in the 4s, and has been all through that run up of when we were at our lows. They were still like a good rate was in the 4s and 5s and things like that. And they've been operating that way. We've just been very fortunate to see rates as low as they have been. Globally, you see in many places around the world, typical rates in the 7 to 9% range. I remember getting a call from a buddy that lives in Bermuda during COVID, and he was wondering, because we were such low rates, he was wondering if there's anything I could do, because he was buying, and really, COVID. Yeah, Bermuda is a tax haven, so people think that it's got to be low rates and all this. He was paying 8%. He was in private banking. He was, does really well. 8% was the best rate that he was going to get, while we were sitting in the 1s. This is before any rate increases. When I speak to clients that are coming over from countries in through the Middle East, like Saudi Arabia or anywhere like that, they're in the 8% ranges. Through Africa, same idea. And that's before, and that was during COVID. That's before this run up of inflation and rates and monetary policy. So we are very spoiled in Canada with our rates. And I know that doesn't help justify anything that we're seeing. And obviously this run up, I hope, comes to an end sooner rather than later, and it comes back down, selfishly also for my own mortgage and my own variable rate mortgage. But
we're just holding on, eh?
Yeah, it is something that
just white knuckling
But to your point of people like over the last 15 years just being spoiled and not seeing rates as high as they are, absolutely. But we also need to be very aware that over that 15 years, your home price has definitely doubled or more than doubled over that period of time.
Yeah,
paid off a ton of principal, and really just feel fortunate of where over that run up of the last 15 years of how well you were able to do over that period. And even in the last 5 years, you've likely seen your home price double, and build that equity wealth within that. So, kind of to your point, hold on right now, kind of weather the storm as much as you can. And what Greg and I were talking about last week is really just look, if you're looking at a mortgage right now and you're a first time home buyer or having to renew or anything like that, the term really, regardless of the term, whether you're looking at 1 to 5 year, it's really just comes down to your budget. Look at your budget, what you're comfortable with. If you don't want to have to go through, analyzing this in 2 years or 3 years, go with that 5 year fixed. If that fits your budget and you're comfortable with that, go with that term, and really just kind of be cognizant of where you're at right now, your affordability at this point in time, and where you're, whether it's going to make you anxious thinking like, I'm going to have to go through this in 2 years or 3 years. Maybe that 5 year is still a valid term for you.
Yeah, I think a lot of people are shifting their financial view on things, right? Like, people had been kind of spending over the last 10 years, again, because of this consistency. I think now the last couple of years have really shown, between the pandemic and rates increasing and so on, I think people have kind of curbed their maybe spending habits. And I saw this interesting thing online earlier. It said, basically, there's no better investment than actually paying off your debt right now, because it's an after-tax return, basically. And for anyone in that kind of 45% tax bracket, the rate of return, I think, was something like 18 or 19% in a TFSA is what you'd have to get to make it as profitable as paying off your debt. Like if you had like a 10% line of credit, basically, you'd have to do, better than Warren Buffett to basically outperform, paying the debt down as far as returns and so on, like true returns. The last thing I wanted to touch on today, at least, was a very interesting chart I saw last week that I did post on my social. So if anyone's listening and you want to actually see it, and you're not watching, it was basically a comparison of rent to mortgage payments in a lot of Canadian major cities. I apologize, not everyone is represented in this chart. I got ripped apart by a few people on Facebook for not including their cities. Okay, well, I didn't make the chart. Okay. But there's some pretty interesting ones here. You can see that there's a massive, what am I trying to say? Disparity. I was going to say disparaging, but disparity in Vancouver. Mortgage payments are at on average about $5,200, and the rent was $3,400. Ottawa's a bit tamer. Average mortgage payments about $2,800. And rent is $2,200, which I think might actually be a bit low on the rent side. I think rent's actually a bit higher than that now, maybe $2,300, $2,400. And there's a few other ones here. Montreal showing average mortgage payments about $2,200 and rent's $1,946. And of course, Toronto mortgage payment averages over $5,000 now is the average mortgage payment, and average rent just under $3,000, $2,937, which is wild. Like, I would love to see this chart year over year, if you could actually see it for from 1919 from 2019 until now, to kind of see how those prices on both ends have increased.
I think, I mean, it is very interesting. It also goes to kind of that notion of how long can some of the mom and pop investors hold on, because every, rental properties right now, and we talked about it, I think, a few months ago, but every, really any rental property, I think it was Greg that said that he was running through the numbers, unless you're putting down, 50%, 40%, the numbers just didn't make sense from where the payments and where the rent is. And so there is a lot there, there is going to be a shortage of single family home, freehold rental options out there, because that's not what the big investors are buying. That's not what the CLVs are buying, or et cetera. These are the mom and pop investors buying single family home rentals and townhomes and things like that. If they're not able to break even, it's a significant loss monthly, which we're seeing, and this chart even illustrates that further. In all these different markets, we're going to see those people having to sell those properties, and rightfully so. And that's going to leave a big hole in the rental market. So again, that goes to, hopefully rates can come down, and that disparity between the two and delta between the two of what rents are and mortgage payments are, that shrinks and becomes more in line and level with where rents are at. So those mom and pop investors that are able to at least cover their expenses and satisfy that need in the marketplace. Oh, you're on mute there, Paul. I don't know what happened.
Son of a gun. Yeah, no, I don't know, I'm back. We're fine. So it's going to be a bumpy ride. And every morning, for whatever reason, whenever I have my coffee in the morning, the throat hates it. It's like, for like the first half hour. Which
an engine
starting
up. An engine starting up, it sputters to start.
I'm like an old lawnmower.
Yeah.
Just kicking here. Well, we got through. I don't know how we got through all those topics. I thought we had a lot of charts to work through, but we did it. Congratulations.
We actually came with charts this week instead of just rambling, which is impressive as well in its own right.
Should we slide into some mood boosts?
Let's do it. We missed them last week, so
yeah. There's a few comments about that in the
we just ended. We just hit stop.
Okay. Thanks to all right, so number one here, where are they? Number one. This is an oldie but a goodie. How do you follow Will Smith in the snow? You follow the Fresh Prince. Yeah,
like that.
I've heard that one a few times, but it's a classic. Number two. This is almost too honest. I thought the dryer was shrinking my clothes. Turns out it was a refrigerator all along. It's a little close to home. Number three. What do you call a factory that makes okay products? A satisfactory. A satisfactory. And I got one closer here. Number four. What did the swordfish say to the marlin? You're looking sharp.
I like those. I like the easy and dumb to the point.
Yeah.
Thinkers, I don't want to think. I don't want to think on them.
Don't get too complex here. Thank you everyone for listening and tuning in. We will be back now. Well, no, we won't. We will be back next week live Tuesday night at 7 p.m. on YouTube. So you can head over there. As we said, we're going to have a guest from Westboro. And this show will be released. It's actually Tuesday today. We're recording the day it will be released. So you're getting it hot off the press today. But typically shows are released 10 a.m. Tuesday mornings. Be sure to subscribe, like, share, comment. And thanks again for listening. We'll see you next week.
Deuces.
Bye, everyone.
Thanks for tuning in, everyone. We hope you enjoyed today's episode. Please remember to like, share, comment, and subscribe because we'd really like that.